Hi there folks, this is Sean Broderick for the Oxford Resource Report. Today I'm going to talk about 3 potential winners and 2 potential losers. First, let's talk about gold. I've been pounding the table about this metal since July. And in fact, gold has now entered a new bull market. It's up more than 20% from its low that it hit back on June 28th. So, that bet on gold is paying off. Let's look at a chart. You can see that gold accelerated to push above overhead resistance of 1400. My new target on gold is 1650. Others are more optimistic. Citibank just put out a $3,500 target on gold. Before we get ahead of ourselves, let's think of how to play it. You can buy the Spider Gold Trust, or GLD, but I don't recommend it. If you want a fund that tracks physical precious metals, try the Central Fund of Canada, symbol CEF. The fund holds both gold and silver, and recently traded at a 2.2 discount to the metal it holds. When I first talked about CEF to Oxford Club members back in July, its discount was over 7%. That couldn't last, and the CEF is up 14.9% from my recommendation. But it still looks good, and should rally along with gold and silver. If gold rallies to 1650, CEF should rise at least another 16%, potentially more. And what if you wanted to play miners? Some miners have done extraordinarily well. A pick I gave Oxford Club members in July is up more than 80%. And some are still bargains, but unless you're willing to do a lot of research, you might want to stick to an ETF. Many people would buy the Market Vectors Gold Miners ETF or GDX, and there's nothing wrong with that. I think it's going to $46 this year, but you might want to consider the Junior Gold Miners ETF or GDXJ. Here's why. Let's look at a chart. You can see that the GDX is testing overhead resistance. More importantly, it has outperformed the larger cap GDX since July, and it's been outperforming gold itself since early August. Things could change, but junior miners look hot now. Gold and silver aren't the only things that are rallying. Oil is breaking out, thanks to rising global demand and worries about spreading conflict in the Middle East. In fact, we're in what I call the third oil shock, something I speak about on my blog. You can play the oil breakout with a fund like the USO, but since commodities in general are rallying, why not buy a broad commodity fund? My pick would be the DB Commodities Tracking Fund, or DBC. Look at a weekly chart. You can see that the DBC rallied through one level of overhead resistance. Now it's testing a weekly downtrend. I think it will break out. A breakout should bring the DBC to at least $30 and perhaps much higher. Now, how about those losers I mentioned at the beginning of this video? Well, as I talk about on my blog, the third oil shock is very hard on retailers. Let's look at the biggest one, Wal-Mart. Wal-Mart looks cheap, but I think it's going to get a lot cheaper. My target is $66 a share. Many retailers are in the same boat. As consumers pay higher oil and gasoline prices, big box retailers get the short end of the stick. You know who's also in a world of hurt? Makers of large mining equipment. Even though gold and silver are bouncing, mining companies have already announced big cutbacks. This is hurting companies like Caterpillar. Look at this chart. You can see that Caterpillar put in a triple top and is now breaking its recent uptrend. It has must-hold support below that, and if it doesn't hold, CAT, or Caterpillar, could go much lower. These are all just ideas. These are not hard and fast recommendations. I am not your investment advisor. Do your own due diligence before you buy anything. That said, these are the trends that I'm seeing in the market right now. Good luck to you all, and good trades. This is Sean Broderick for Oxford Resource Report. Thanks for watching.